All right, looks like the waiting room is clear and we are after 1 o'clock, so we'll get started. Like I mentioned, or like Max mentioned, my name's Steve Wildman. I'm with Diversified. Want to welcome everyone to our webinar this afternoon, Financial Foundations, a guide for young adults starting out. So first of all, I want to say congrats and good on all of you for attending a webinar like this. I know it's probably not your ideal way to spend an hour with us on a Wednesday afternoon, but I know Max can probably echo this, but I've certainly made a lot of financial mistakes in my previous life, and if I had those back, I would take the opportunity to do that. But again, good on you for learning more about this topic and hopefully avoiding some of those same mistakes that I know I made. So, a couple housekeeping items, and then I'll hand it over to Max Berger, who's the real talent on the call, to walk us through the presentation. If you have any questions, there is a Q&A button. It says Q&A with a little question mark inside a box at the bottom of the Zoom screen. If you have any questions, feel free to use that box to submit those. We have about 20 minutes of content here, and then we do have time at the end saved for any questions that come from the audience. So feel free to ask if you have those. And like I mentioned, 20 minutes is the presentation, and we have time at the end for some questions. So thank you all again for attending. Hope you all learned something. And without further ado, I'm going to hand it off to Max. So Max Berger is a senior wealth advisor here at Diversified. Max knows firsthand how confusing money can feel, especially when you're just starting out. So today he's here to make things simple for you. With a background in finance, tech, and real-world experience, helping clients create smart and personalized money plans, Max breaks down concepts in a way that actually makes sense. So Max, I know he has a robust history that I'm not going to go fully into, but he's worked at startups, major investment firms, and now helps people just like you and others make confident financial choices, whether it's setting up a budget or understanding your 401k, maybe for your first step of your career outside of school. And also, I know a big topic these days is student loans. So all those things under the sun is what Max speaks about on a daily basis. On the personal side, Max lives in Philadelphia with his wife, son, and expecting another, and two pups that he loves very much. And when he's not helping people plan for their financial futures, he's usually outside hiking, which I didn't know, working out and enjoying time with family and friends. So with that, Max, I'm going to turn my camera off to not be a distraction, to let you have the stage, and I will see you soon for Q&A.
All right. Well, thank you for the warm introduction. As Steve mentioned, my name is Max Berger. I'm a senior wealth advisor here, and really the goal of today's webinar is to provide some information for those folks who are entering school, just having graduated, or maybe spent a couple years in the workforce, really to give some insights and guidance for things that I know I would have appreciated when I was in those shoes. So the agenda for today is overall just giving you more confidence in how to manage your finances. We're going to talk a little bit about budgeting and some strategies there. We'll talk about some investing basics, 401ks, Roth IRAs, things of that nature, and then also touch on student loans and building credit and overall smart money habits. So why this matters: 63% of Gen Zers, which are those who were born 1997 to 2012, say that money is their number one stressor. And so there's a lot of things that if you can start doing now at this stage of your life, it's going to give you more flexibility and more freedom for later on. To talk a little bit about budgeting, there's a lot of rules of thumb out there about budgeting, but the way that I like to break things down is when you are working for a company, or maybe you're running for your own business, you have your take-home pay, which is what hits your bank account after taxes, after healthcare, after maybe contributing to something like 401k. And there's a rule out there, the 50-30-20 rule, that says have 50% of your after-tax income spent on your needs. So rent and housing expense, groceries, utilities, 30% on wants, going out to dinner, traveling, being with friends and family, and then 20% on savings and paying down debt. So really, this doesn't need to be perfect. It's just to get you to start thinking about where your monies are going. So there are a lot of budgeting apps out there. Credit Karma has a popular one. You Need a Budget, which is YNAB, is another popular one. But even very simply, if you take a look at what your take home pay is, whether you get paid every 2 weeks, every month, and splash that onto an Excel sheet and start subtracting out and calculating things like your rent, your utilities, car payment, to just get an overall picture of the biggest percentages of where your money is going and being cognizant of all that. In terms of saving, the exciting thing to talk about is saving towards investments, saving towards stock market, which we'll touch on as we go through this, because that's where you get maximum growth on your dollars over the long term. But really, you need to walk before you can run. And what I mean by that is building up a emergency fund is the first thing that I tell people when they're starting off in their savings journey or working journey, really. And so the rule of thumb is 3 to 6 months of expenses set aside in savings. So if you spend $5,000 a month, you want to have 15 to 30,000 set away in your savings account, because before you can start investing, the goal is that you want to have enough set aside to help pay for those unforeseen things that happen in life, so that you don't have to dip into investments or take out debt in order to pay for those things. So a good way to do that is you can set an automated amount after you do your budgeting and see how much extra that you have after tallying up your expenses, to set a certain amount aside to build up your savings and get it to a place where you've built that emergency fund. I think the other important thing here is using something like a high yield savings account. So for example, there's traditional savings accounts with a bank. They pay very little interest, but there's high yield savings accounts out there. There's a lot of them. For example, I use one that pays 4.1% interest. It's FDIC insured, and that's where I keep my cash savings so that I can get my money to work for me, as opposed to just sitting in a bank savings account. So those interest rates will move as interest rates change over time, but it's still going to pay more than traditional bank savings account. And it's very easy to transition money over from checking to savings if you need to put more in or take some money out. Now we get into investing. And primarily what we do here is help clients invest their funds in stocks and bonds. So at a very high level, when you think about stocks, or equities as they're also called, you are buying ownership in a company. So if you're buying a share of Apple, you're buying a share of NVIDIA, you are a part owner in that company, with the hope that the earnings and the profits of the organization are going to continue to increase. And therefore, the stock that you own, the ownership of that company, will increase as it gets more valuable. That's the hope. The flip side is that if you own a small piece of ownership in a company, if earnings are going down and the company's not doing well, your percentage of ownership is going to decrease. So it says they're higher risk, higher potential reward. Bonds, on the other hand, are a more stable type of investment. And there's a lot of different types of bonds out there. The bond market is actually much bigger than the stock market, which a lot of people don't know, because most news outlets and online are talking more about the stock market. But the bond market is US Treasuries. There's those companies that I just mentioned, they can write bonds for themselves, and it's a more stable investment. So if I buy $1,000 bond from the US government, I'm going to get a certain percentage of interest over a certain period of time. And then at the end of that, let's call it 10 years, I'll have gotten 3-4% interest annually, and then I'll get my $1,000 back at the end of that time. So I know that that investment, essentially what's going to happen, there'll be some fluctuation in the bond that I actually own, but the stock market is where you get the real growth potential on what you're investing in versus the bond is market is being more stable. And depending on where you are in your life or your risk tolerance, it's good to diversify your portfolio among stocks and bonds. The way that most people do that is by utilizing things like index funds or mutual funds within their 401ks or within their IRAs, because you're getting exposure to a large swath of the market as just opposed to buying individual bonds and stocks. To talk a little bit about compound interest, which people in the financial world say is the eighth wonder of the world, really it's that your money is going to continue making more money for the longer that it's been invested. So let's take this example, for instance. If you save $55,000 at age 22, one time $55,000, it grows at 7% a year for the next 43 years to get you to age 65, which is a general retirement age that many people use in the industry because that's when retirees will get onto Medicare. That 55,000 will turn into $1 million at age 65. And it's because another rule in finance is the rule of 72, meaning if you take 72 and you divide that by the rate of return, that's how frequently your money is expected to double. So in this example, 7% rate of return, your money's going to double about every 10 years. First 10 years, you're going to grow from 55,000 to 110. Then that 110 becomes 220, 440, 880, and so on. So as your money grows, your money is making more by doing nothing. And we like to say that it's a marathon and a sprint. Of course, when you're young, you're doing what you can and saving what you can as you start out your career. But even if you can do a little bit and save into the markets, that money is going to grow and compound over time, and you're going to be very happy with where your money's at when you pick your head up. When talking about really what you're saving into and why we're saving, you see here there's different types of retirement accounts, 401ks, Roths, IRAs, traditional IRAs, for example. And the idea is that a lot of people don't want to work forever. And at the end of the day, your working income is supplying you to live your lifestyle between now and when you retire. But then when you retire, you're going to have Social Security, maybe a pension, which I'll talk about in a moment here, and your investments now to be able to pay for your lifestyle expenses and allow you to live and travel and enjoy life. So that's the reason why people invest, and the different types of vehicles that you can invest into are things like 401ks. So if you are working for a company that offers a 401k or 403b, it's a great way to start saving. It comes out of your paycheck, so it's out of sight, out of mind. A lot of times there's a company match on it, which is really free money. So for example, if a company matches 50% of your contributions up to 5%, that means you get a 2.5% match where you're putting in 5% into your 401k and they're putting 2.5% in. So it's a great way to be able to save. The maximum that you can do to a 401k is 23,500, at least in 2025. Those amounts change every year, and you can make Roth contributions or traditional contributions. So I'm sure you've heard those terms thrown around, but at a high level, traditional or pre-tax dollars come out before you pay the taxes on them, whereas Roth is after-tax monies that grow tax-free forever. So let's say you get paid $10,000 and you invest $1,000 pre-tax into your 401k. The company will take that $1,000, put it into from the 10,000, they'll put it into your 401k, and then that 9,000 that's remaining gets taxed. And then that $1,000 is going to grow what's called tax deferred until you take money out and you pay taxes on that. For Roths, in that example, if you get paid $10,000, that money will be taxed. And then after that, you'll put money into the Roth 401k. So in that instance, your take-home pay is actually a little bit less, but you're getting that money to grow tax-free in there forever. So when you're earning a little bit less in your earlier years, you could look to do a Roth then because you're not in the highest tax bracket. And then as your your income increases, then it may make sense to do more of the pre-tax side to help reduce your taxable income. The other types of accounts that you can invest in are really a non-qualified account, brokerage account, investment account. Those are all synonymous. Those are unlimited flexibility. So 401ks, IRAs, for example, they have limitations on how much you can put into those and how much you can take out. For an investment account, you can put in however much you want. The idea is that you're saving for the long term, but should you need to tap into those monies, you can take it out of that account. So IRAs and 401ks, they typically have penalties for taking those monies out before age 59 and a half in the IRS's mind. But for example, I have a joint brokerage account with my wife. And when we bought our first house, we took some monies out of that investment account and used it for our down payment. Now, pensions you don't typically hear about anymore, but further in time, there were companies and the government that was giving you a fixed income in retirement after working for X number of years. So you see it right there, guaranteed lifetime income. You'll still see them for federal workers, for teachers, for law enforcement types of positions. And there's options to get a guaranteed income from the government or from the organization, or sometimes even a lump sum pension. Pensions are structured very differently depending on the type that you are is offered at your employer. And they're fewer and far between because it's a big cost to the company to provide that income and those funds to employees for a long period of time, especially with people living longer right now. More times than not, it is on individuals to be saving for themselves and then using that money with working with a firm like Diversified to be able to provide them with that income in retirement so that they can eventually stop working. But if you do have a pension or 401k or 403b, it's really important to understand the retirement benefits that are offered at your workplace, which we can certainly help you take a look at. That's what we do every day for our clients. Now, student loans, the reality is that the cost of college is very expensive, and the majority of Americans are graduating with some kind of student debt. There's different kinds of loans, federal versus private. And with the federal loans, those are where you see some of the things like you see in the news, where there's potentially loan forgiveness, there's different repayment plans like income-driven repayment plans, standard repayment plans, and it all depends on what your goal is. Income-driven repayment plans is what allows you to, on federal loans specifically, really have as small of a payment initially to try to just help get you on your feet. And then as your income grows up, your payment towards your loans is going to be more. A standard loan repayment is a steadier way to pay off your loans where you're paying less interest over time, but the payment is likely going to be higher initially than in an income-driven repayment plan, depending on how much you make. In terms of private loans, that's where you have opportunities for refinancing. You don't have loan forgiveness for private loans. It's really only the federal loans. And the reality is, if you've kept your eye on the news, there's so much changing in this space. So We help our clients through this type of thing a lot. And if you want to talk through the best way to help pay down your student loans, those are all things that I and we would be able to help you with. For building your credit, which you hear a lot about as well, that's what helps you get out a mortgage and be approved for a loan. So if you have a healthy credit, it allows you to be eligible for larger loans, larger credit limits on a credit card, for example. So the first thing that you see on here, opening a secured credit card, is an option for somebody that has little credit, where you can make an initial deposit and serve as some collateral to really start to be able to apply for and get a credit card. You see here, always pay your credit on time, right? You don't want that credit card balance to build up. And that's the portion there where it talks about keeping credit utilization under about 30% of your limit. Meaning if you have credit cards and there's $10,000 limits, you don't want your credit balance, ongoing balance over a monthly period, to be over $3,000, for example. So it's important to review your credit, just because you don't know what can be out there. You could have a late payment on something that you don't even know about that's affecting your credit score. And you can pull your free credit report at annualcreditreport.com. So that's just a tool to keep tab on things, honestly. So we talked about a number of different things today. And I think the basic thing is keeping an eye on your overall expenses and understand what you're spending your money on, whether it's fixed expenses and needs, whether it's wants and how much you're saving. The second thing is building up that emergency fund, because the goal is you don't want to have to tap into investments and go into debt to be able to handle your ongoing expenses and some of those unforeseen things. Once you can build up that emergency fund, that's when the fun begins. That's when you can start investing in the stock market, putting towards your 401k, other types of investments, and watching your money grow. And then really helping navigate your student loans, which is unique to everybody's situation, and making sure that your credit score is starting to build by paying things on time and not taking out too much debt irresponsibly. So with that, I will open it up to any questions that we have here. And I'm just checking the Q&A here. Do we see anything in there, Steve?
Yeah, we do. Thanks, Max. So we had a couple come in. I was guessing that this would have been a question asked. Question is, I just started my first full-time job. Congratulations. How should I prioritize saving for retirement versus paying off student loans?
Yep, that's a great question. And I think it starts with what we said in terms of breaking down your expenses and your after-tax pay. Number one, I would tell you, if you're able to, and especially if your company has a match on your 401k, I'd recommend doing what you can to your 401k to get the free money and get the full match. Pay what the minimum payment is on your student loans, and really just get your feet under you. And then ultimately, as time goes on, if you're in a situation where after making minimum payments on your student loans and after contributing to your 401k and getting the full match, you have extra dollars to work with, then it becomes a conversation based on your needs and your goals, based on how much debt that you have, based on if you're trying to save up for a car or buying a home, for example, to game plan what to do with those extra dollars. So it's not a blanket answer. It's situational. My recommendation would be get full match if there is one, pay the minimum payments to get on your feet, and then make sure and see really what that excess is as you start working. And then from there, you can game plan if it makes sense to pay down the student loans faster, invest more, or maybe a combination of both.
Got it. Excellent advice. So we have one more, Max. We can certainly answer any that come through. But the second question is, I've heard about investing early. And you kind of walked through that, Max, earlier, but I'm nervous about the risk. You mentioned risk versus reward. How do I start investing early with confidence when I don't have a lot of money to invest?
So part of this is just understanding and living through what they call a market cycle. But at the end of the day, I talked a little bit about stocks and bonds, stocks being higher growth, bonds being a little bit more stable. For somebody who's in their 20s, 30s, et cetera, and probably has a lot of time until their retirement, you're looking for maximum growth on your retirement accounts and your retirement dollars. So really the recommendation there would be to be 100% stocks. In years where the market's down, you are going to see your account go down, and it's not pretty. But the markets have always gone up over time. They've been measuring the markets for 100+ years. 3 out of every 4 years is typically up in the markets. And the best way to navigate through those times is really just to stay the course and keep adding money and buying low, as they say. And the best way to start investing in the markets is by getting into mutual funds or ETFs, which stands for exchange traded funds, to be able to get access to the full markets at a small amount of money. And that's going to allow you to participate in the growth. And the best thing that you can do is save a little bit and understand that there's going to be swings, but that's okay, because you're not necessarily investing for today. You're investing for the future.
Sounds good. One last one came through, and just a reminder, folks, the Q&A button at the bottom of your Zoom, you can answer or type in your questions. The last one we have here so far, Max, is what's the best way to create a budget that works for someone like me that may have a variable income, like part-time work or freelancing, something of that nature?
Yeah, that's a good question. And really it's to understand a little bit of an average, number one. And number two, for somebody in those shoes, it's going to be to probably have a bigger emergency fund than the average person. So we say 3 to 6 months, because your income could be lower from one couple months to the other. You might want to have a bigger cash savings to be able to navigate through those times and not get into credit card debt or tap into investments in those scenarios. So for somebody in those shoes, I would recommend at least 6 months of your expenses set aside in cash, and then really getting a feel for the variability. I mean, in those types of businesses, there can be cyclicality during different seasons or times of the year, or maybe it's just completely random based on the months. So the recommendation would be feel it out. You got to feel it out a little bit over the course of a year or two as you get to learn the business, but have a bigger buffer for somebody like you to make sure that in months where income is lower, you're able to manage your expenses and navigate through that until income jumps up.
Awesome. Well, Max, that is all the questions that we have so far are in the queue. So we'll shut it down. But Max, thank you for taking the time to walk through this topic. It's certainly a very important one, especially for, I'd imagine, the most or the bulk of our audience. Folks out there in the audience, if you have any questions specifically around your personal financial situation, you see Max's email on the screen here. You can also scan this QR code. And reach out. We love to again, this is our business. This is what we do. We love these conversations. So please don't feel like any conversation is one that we won't have. But with that, this webinar is recorded. So you should get a recap or a recording of this in your email in the next couple of days. Especially if you joined late or were jotting down notes and missed something, you'll get a recording, and feel free to share this as well for anyone that you feel could benefit. But Max, thank you again for your expertise and advice, and hope everyone has a great day.
Thanks, Steve. Have a great rest of your summer, everybody.
Take care.